Hello and welcome back to the Financial Freedom Show. In today's video, we're going to be covering VUG and why it'll outperform in the next couple years and why I'm buying it in my Roth IRA. If you enjoyed today's video, please be sure to hit the like button and comment down below what you're adding to your Roth IRA now that the new year has reset. And if you'd like to have your name featured at the end of every single video we publish, please be sure to join the channel down below in the description. And without further ado, let's get to today's video. So the Vanguard Growth ETF, or VUG, is a cornerstone investment for those seeking exposure to U.S. large cap growth stocks. Known for its strategic focus, low expense ratio, and diversified portfolio, VUG has gained significant traction among investors looking to capitalize on the potential of growth-oriented companies. This video is going to delve into the details of VUG and why it'll outperform in 2025, exploring its composition, performance, benefits, and considerations for investors. So first off, what is VUG? VUG is an exchange-traded fund, or ETF, managed by Vanguard, one of the largest asset management firms in the world. It aims to track the performance of the CRSP US Large Cap Growth Index, which consists of stocks exhibiting characteristics of growth, such as high earnings growth rates, strong revenue growth, and above average price to earnings ratios. It was launched in 2004, and VUG has become a go-to option for investors seeking exposure to growth-oriented companies, particularly in sectors like technology, consumer discretionary, and communication services. VUG is home to a collection of high-performing, innovation-driven companies. The ETF's largest allocations include well-known names like Apple, Microsoft, Amazon, Tesla, and Alphabet. These companies are market leaders in their respective industries, leveraging technology and innovation to maintain competitive advantages. VUG is heavily weighted towards technology, approximately 50% of it is technology, followed by consumer discretionary and communication services. This allocation reflects its focus on sectors that historically drive growth during economic expansion. With over 200 individual holdings, VUG provides broad diversification to large cap growth stocks, reducing the impact of volatility in any single company. VUG has consistently delivered strong performance over the years, reflecting the resilience and success of its underlying holdings. While past performance is not a guarantee of future results, VUG's ability to generate returns during periods of economic expansion and market upswings makes it a compelling choice for long-term investors. Annualized returns. Historically, VUG has outperformed the broad market ETFs during bull markets, benefiting from the performance of growth stocks. And volatility. Growth-focused ETFs like VUG may exhibit higher volatility compared to value-focused ETFs or the broad market indices. However, this volatility is often rewarded with higher long-term returns. One of the main standouts of VUG is its low expense ratio of 0.04%, significantly lower than the industry standard for growth-focused ETFs. This cost efficiency ensures that more of an investor's capital remains invested and compounds over time. Although growth stocks typically reinvest profits into business expansion rather than paying dividends, VUG does offer a quarterly dividend distribution. These payouts, while modest, provide investors with a small income stream alongside capital appreciation. So who should invest in VUG? VUG is best suited for investors who have a high risk tolerance and long-term investment horizon. Its focus on growth stocks means that it can experience periods of heightened volatility, particularly during market downturns or economic uncertainty. However, for those willing to weather short-term fluctuations, VUG offers significant potential for long-term wealth creation. Growth stocks can be more volatile than income-focused investments. VUG is also ideal for investors planning to hold their investments for at least 5 to 10 years. And lastly, VUG works well as a core holding in a growth-focused portfolio or as a complement to more conservative investments like SCHD or bonds or dividend-paying stocks. There are several benefits for investing in VUG. The first is exposure to market leaders. VUG includes some of the most innovative and successful companies in the US economy. Secondly, sector leadership. This ETF is weighted heavily towards sectors poised to benefit from the long-term trends like digitalization, AI, and sustainability. The third thing is cost efficiency. Its low expense ratio maximizes investor returns over the long run. And lastly, diversification. Broad exposure to multiple companies reduces risk. While VUG offers many advantages, investors should also be aware of its potential risks. The first is market volatility. Growth stocks are more susceptible to sharp price swings during market downturns. The second is economic cycles. Growth stocks may underperform during economic downturns or periods of rising interest rates. And lastly, concentration risk. Heavy weighting in technology and consumer discretionary sectors may lead to overexposure to specific market trends. The Vanguard Growth ETF, or VUG, is a premier investment vehicle for those seeking to capture the growth potential of U.S. large-cap companies. With its low expense ratio, diversified portfolio, and focus on market-leading sectors, VUG offers an attractive balance of risk and reward. While it's not immune to market volatility, its historical performance and strategic composition make it a strong contender for long-term investors aiming to build wealth through growth-focused investments. For those who are ready to embrace the opportunities presented by innovation and economic expansion, VUG stands out as a compelling choice for the ETF landscape. So why will VUG outperform in 2025? VUG is poised to outperform in 2025, driven by favorable economic conditions, technological advancements, and a renewed focus on growth-oriented sectors. This video is going to explore the factors contributing to VUG's potential success, including its strategic focus, the economic environment, and the resilience of its top holdings. The first thing is the strategic focus on growth-oriented sectors. VUG is designed to capture the performance of U.S. large-cap growth stocks, emphasizing companies with strong potential for revenue and earnings growth. Its portfolio includes leading technology, consumer discretionary, and communication services companies, sectors that are expected to thrive in the coming years. With holdings with recent innovations such as Apple, Microsoft, Amazon, and Tesla, VUG offers exposure to industry leaders that are going to outperform in 2025. As the global economy becomes increasingly digital, companies in VUG's portfolio are positioned to benefit from the secular trends like cloud computing, AI, e-commerce, and renewable energy. These growth drivers are expected to fuel robust earnings for VUG's top holdings in 2025. The second thing is economic tailwinds in 2025. Economic conditions are expected to support growth-oriented investments. Moderate inflation, stable interest rates, and a resilient labor market create an environment where growth stocks can thrive. The Federal Reserve's commitment to maintaining balanced monetary policies could further bolster investor confidence, reducing uncertainty and encouraging investments in growth-focused ETFs like VUG. In addition, continued government incentives for technology development and sustainability initiatives will benefit many of VUG's holdings. Companies leveraging these incentives can expand operations, develop innovative products, and capture new markets, all of which contribute to strong financial performance and ETF returns. The third thing is resilience and adaptability of the top holdings. The resilience of VUG's top holdings is a significant factor in its outperformance. Companies like Alphabet and Meta have consistently demonstrated their ability to adapt to market challenges and capitalize on emerging opportunities. For instance, the continued rise of AI and augmented reality presents massive growth opportunities for these two firms. Moreover, many of VUG's companies maintain robust balance sheets, enabling them to invest in research and development, execute strategic acquisitions, and weather economic uncertainties better than their peers. These attributes ensure that VUG remains a reliable vehicle for capturing the growth potential of market leaders. And the last thing is the historical outperformance and investor sentiment. Historically, VUG has outperformed many of its peers during periods of economic expansion and technological innovation. Its track record of delivering strong returns has earned it a loyal investor base, ensuring that consistent inflows of capital are present. As more investors continue to recognize the long-term potential of growth stocks, VUG is expected to see increased demand driving up its performance. But as always, past performance doesn't include future results. The Vanguard Growth ETF, or VUG, is well positioned to outperform in 2025 due to its strategic focus on high growth sectors, favorable economic conditions, and the resilience of its top holdings. As technology continues to reshape the industries and the economy, VUG stands out as a compelling investment choice for growth-oriented investors. By capitalizing on innovation and market trends, VUG offers the potential for substantial returns, making it a top contender for outperforming broader market indices in the year ahead. Hope you enjoyed today's video of the Financial Freedom Show. If you did, be sure to hit the like button, and don't forget to subscribe in order to stay up to date with any future videos we post. Comment down below if you're adding VUG to your portfolio. Thanks for watching, and I'll see you in the next one.